Hello, friends. Good afternoon or good morning to you. Nice to see some of you already in the chat. Hello, hello. Sound check 1 2 1 3 1 4 1 6. All right. Let's do this. Hello. Hello. Welcome, my friends, to Alpha Beta Soup Live. I'm TXMC. It is December 13th, 2023. It is what day of the week is it today? Wednesday? It is Wednesday. It's FOMC Day. Very exciting. If you haven't already, make sure you hit that like button. It's the best way for you to support the channel, aside from subscribing to the channel. I appreciate some of you coming in here early and hanging out. You're already ready for the stream. Amazing. How's everyone doing today? I think this is our first live stream that's actually on FOMC Day. I didn't really intend for that to be the case, but it's okay. The press conference is in a couple hours. We should be done before that starts. Find a theme song for my channel. Well, I have an intro. I have an intro song. That song belongs to me. It's mine. I bought the rights to it. Someone else made it. But you're right. Maybe I need some background music. That's true. So let's look around the markets, huh? This morning, I've been trying to put together some data for my recession tables that we look at quite a bit. So I haven't been super closely looking at the equity markets or Bitcoin or anything the last hour or two. I can only focus on one thing at a time. So we'll just kind of look around together and see what's going on, yeah? You know, just looking at this, it looks like a pretty mild risk on day. You know, you've got yields down, got assets up or flat. Dollar's kind of flat, Ethereum's kind of flat. But the S&P creeping into the green, the Dow's flat. We'll see how it plays out here. The market's been open about 2.5 hours, but it's FOMC day. And today, I think the market is expecting this to be one of the more important FOMCs of the year. It doesn't mean that it will mark some kind of a turning point or anything like that, but you know, some meetings are more important than others. And the one today, I think, is quite important because Jerome Powell has now not raised since July. We've had 2 FOMCs where he hasn't done anything. And when you look around the landscape, the market is expecting that we're near the end of their tightening, right? If we go look over at the FedWatch tool, they're expecting today to be a pause, not to be any change. You know, there's a 1.8% likelihood based on positioning that the market's thinking the Fed will change the Fed funds rate and raise it 25 bips. But the vast majority of the market's consensus is expecting nothing to change. So what will be interesting to look at today, if you're a Fed watcher, if you're not, this isn't important to you, but if you're a Fed watcher, then the interesting things will be Powell's own word choices and his tone and the way that he describes whether or not current policy is sufficiently restrictive to return inflation to 2%. That's the language that they've been using since early 2022. Sufficiently restrictive. So when you look around, you see the market expecting these cuts. You can see them as soon as May. Right here, market is expecting cuts. Just so that I don't assume you know how to read this, let me explain this table. These are the meeting probabilities for the Fed funds rate for all the FOMCs through next year. You see this right here, these dates? And right now, this is where we are. We're at 525 to 550 on Fed funds. And through January, there's an overwhelming consensus that rates will probably not change. But once we get to March, it's closer to a coin flip, and there's actually some expectations that rates could even be cut by 25 bips as soon as March. But then once we get to May, the consensus, while it's still a coin flip probability, the distribution overwhelmingly favors at least a 25 basis point cut by May. Perhaps March, but by May. So that's the way to look at this. And then you can see with each subsequent meeting, these blue boxes are moving to the left, which means that we're cutting 25 basis points at a time from each FOMC starting in March onwards. That's what kind of the market is expecting to happen. And the main reason they are expecting this to happen is because CPI has been coming down. CPI is falling. It's now, I think, 3% as of the meeting yesterday. Let's go Forex Factory. Let's go look at CPI year over year, 3.1. Okay. So it's about 3.1%. And the market's seeing that. They're seeing the pace of it coming down pretty sharply, even though there are components inside of CPI, like different aspects of it that are holding up. The headline figure is falling. And I think that the market is just kind of getting really, the words I'm looking for here, they're expecting the Fed to surgically lower interest rates in a way that doesn't restoke this inflation, but allows the refinancing channel to be opened up. You know, there's a lot of people holding debts that haven't refinanced yet because the increased service cost, like if you refinance to current rates, your debt payments will be exorbitant. So they're waiting for Fed cuts, and they're starting to get excited that we might actually be near that point. But what makes it difficult is that we don't really have any historical examples of the Fed doing that, of them surgically lowering interest rates 25 bips at a time from where they are, from 550 down to a significantly lower level that doesn't restoke inflation. We just don't really have an example of that. We've got some examples of soft landings, but they were all much more brief than this. The only other one that we're still holding on to is the 1966 example, but we've broken away from it in certain places. But the most recent one is the 1994-95 period of time, which was, let me go find it on the price chart. This is the NASDAQ. Was right in this period right here. You see this little brief trough in the NASDAQ in 94-95? This was kind of a soft landing. This was a Greenspan engineered soft landing, where he tightened just a bit to try to slow the economy down, but then he eased again. So there was a really small kind of Fed cycle here in the mid-90s. But we didn't have a yield curve inversion. We didn't have the cyclical aspects of the economy looking as they do. We didn't have the labor market showing signs of weakness in some of its leading parts the way that we do today. So not really a great example, but this is kind of a period of time that these soft landing bros are looking at and saying, look, we can totally pull this off. And maybe they're right. Because if we're honest with ourselves and we look at, this is our employment growth chart of today versus 1966 in purple and all other recessions in gray. We've looked at this quite a bit. We're right here. Just out ahead of us, there are 3 or 4 examples of recessions happening, and this takes us through about March, April of next year. And once we get past that point, we don't have any examples of recessions occurring with everything else that's already occurred relative to those time periods. So if we're using the yield curve inversion as an anchor, then it's about 18 months. That's the longest wait time that we have of an example of a recession beginning. That was the Great Financial Crisis. It took 18 months. 18 months from our yield curve inversion would be March of next year because we inverted in October of last year. So that's around the period of time when we start running out of examples of recessions. I think that if I'm looking at this objectively, while there is still the strong likelihood that we have a recession, we're not out of the woods yet. We've got to start thinking, okay, what could this look like if we pull this off? And so, if we think like the market's very excited that the Fed's going to pull this off. So how could they pull this off? We've got job growth slowing. We see that here. The rate of change is coming down, but it's still positive, right? And it could remain positive. It's not guaranteed to go down. It just means that history is pretty clear that most of the time it does this. But it doesn't have to, right? Like that's this line right here that you're looking at. Most of the time it does this. It doesn't have to. This isn't a prescription. This is a distribution of outcomes. This is a historical data set, right? It's not a prescription for the future. So job growth could do this and start climbing again, or go into a bit of a stasis for a bit longer and start climbing again. I don't know. It doesn't have to go negative. So if we fast forward our minds to this period of time on our chart, where we get out beyond here, we're past the great financial crisis example. This would be March, April, May, June. If we get into this window of time and job growth has stayed like this, and the cyclical parts of the economy are holding up the way that they very recently have started to appear to, and the Fed is maybe even cutting rates, maybe some of these things start playing out. Maybe they cut a couple of times just to keep real interest rates relative to inflation in a range, right? So that we don't have a passive tightening because inflation keeps falling and rates aren't moving. So if they just kind of cut a little bit and job growth stays like this, and the cyclical economy, which is starting to turn up a little bit, if it continues to look like that, then by the time we get to May or June, any idea of a recession would be very strained. The concept, if we were still holding on to the same bias right now, by the time we get to May and June, but all of the data looks better, then we're going to be really challenged in continuing to make that argument. So there is a window. There is a needle that can be thread here. There always has been. It's never been impossible. But we were too far away to really give it any kind of serious consideration. Well, as we approach the turn of the year, as we get into a 1 or 2 quarter distance from when we run out of examples of recessions, now's the time for us to be more realistic about whether or not we can pull this off. I still remain pretty cautious. I think that there are plenty of things could surprise us in the next half a year. That is quite a bit of time. But we're getting close to Powell maybe being able to declare victory. Now, there's still a lot of things to be concerned about. We're still in a delinquency cycle. We explored some of that in the last couple of streams, where we've looked at rising credit card and auto loan delinquency rates for multiple different sectors of the consumer. That is a concern. We have rising bankruptcy filings with businesses. That's a concern. We've got a lot of debt that is just kind of stuck where it is because it can't be rolled at the current cost of money, right? You've got people that financed at 2, 3, 4% rates, and now the rates in their market are 5, 6, 7, 10%, depending on whether you're a corporate or you're someone trying to take out a mortgage, you're trying to get a personal loan, whatever that is, right? And so those things are still playing out. And I think the difficult task for Jerome Powell and for Janet Yellen also, who's kind of his sidekick in all of this, her policies have been helping to ease financial conditions while Powell has been on, the warpath with rates. There is a possibility for them to thread the needle, but the thing that I keep running into, the data looks the way that it is, the timeline is what it is. However, if you think about the rate that rates changed, right? Let's pull up the Fed site. Let's pull up the Fed site and let's look at the 10-year yield. Fed funds. Let's look at Fed funds. With the rapidity of the way that rates moved, with how quickly They went from 0 to 5. We operated down here in this range. Let me get my drawing tool. We operated down here in this range for the better part of a decade, right? And a lot of debts were accumulated down here. A lot of businesses were formed down in this place. And there are currently a lot of liabilities being paid for that have interest rates that still exist from this period of time. But in a very short amount of time, rates have essentially like quadrupled from where they were down here. Fed funds has, right? Corporate rates are about double where they are. Mortgage rates have about doubled from where they were. At one point they had tripled, but they've cooled off a little bit. And I think that the difficult task, and it's one that I've been tweeting about actually. If I go back to my Twitter, let me find it. It was a tweet I just sent yesterday, the day before. Here it is. I've been looking at the debt structure, and I'm trying to get my thoughts together to make this point for you guys. So you've got all these people holding debts at rates that are significantly below current market rates. And many of those borrowers are expecting the Fed to cut rates soon. That's part of the reason I think people are getting really excited about their positioning and their expectations. They're expecting the Fed to cut soon because we're about as long as we've ever been in a tightening. Excuse me, I get the hiccups. I get the hiccups a lot when I do these streams. We're about as deep into a tightening cycle as we've ever been. Inflation is starting to come down. Financial conditions are easing. We're not seeing, we're not seeing inflation remain as stubborn as we thought it was 6 months ago, though there's still parts that are stubborn. But we've still got all these debtors holding debts with rates much above market. And so there's this battle of wills going on where you have a bunch of people white knuckle gripping debts that they cannot afford to refinance at the current rate. But the amount that the Fed is likely to cut just to kind of maintain financial conditions where they are is probably not enough to open up the refinancing channel for a lot of those borrowers. Because those borrowers, like if you are, let's use an example. Let's use a practical example. Me, I refinanced my house in early 2021. My mortgage rate is 2.75%. The current mortgage rate is what? 4.45. Oh, that's not right. 7%. So the current mortgage rate is about triple mine. It's a little bit less, 2.5 times mine. If you're someone who is hoping to refinance your home, let's say you took out a mortgage over here. Let's say you took out a mortgage in early 2022. Let's say you're not even me. Let's say your rate is even higher than mine. Let's say your mortgage rate is 4%. You bought a home in Q1 of last year. It was really expensive, but you did it because you got told the Richard Kiyosaki thing of buy the house now, refinance when they cut rates, do a cash out refi, and you'll be good to go, right? Well, look at the distance here that the Fed would need to cut for a refinance to even make sense for you, right? You're not going to refinance up here. You're not going to refinance right here. You need rates down here for it to even make any sense, right? Otherwise, you're still coming out ahead. This is a dynamic that exists in a lot of different markets right now, in corporate debt markets and private credit, like across the spectrum. There are borrowers holding loans, for lack of a better word, with rates somewhere in like this loose box, right? Significantly below market. And the only way that a refinance or a roll of those debts is even feasible for them is for the Fed to cut all the way back down into this range so that they can actually lower their debt costs by doing so, or at least keep them where they were the last time they borrowed. That's a lot more than a couple of 25 basis point cuts like this is currently pricing in. This is pricing in 5 or 6 of them over the entirety of next year. And that would still, just based on mortgages alone, would only get us to like right here. Right here. So everyone who refinanced in 2022, or really who took out debt any time in the past, any corporate, who took out a loan before that, you're waiting for the Fed to cut a lot more. I think that's a very precarious situation for the economy, because the credit edifice has been completely choked off, right? We've talked about some of this before. If we look at credit as it relates to here, if we look at the credit markets relative to Fed tightening, the rate of change is completely choked off, right? It's completely stalled. If we go look at the Fed website and we look at bank loans and leases in bank credit, look how it's basically flatlined here. Like it's still going higher, but the rate of change has slowed down quite a bit from where it normally is. So on a rate of change basis, that's kind of what you're seeing over here. It's harder to see on that chart. It's better to see on this chart. The rate of change of bank loans has slowed down significantly. Credit has slowed significantly. Banks have tightened their lending standards. They're not looking to create credit. And so we're in a weird situation where you've got all this outstanding debt. Some of it simply can't be refinanced and will just default. Or they'll have to do it at a higher rate, and that will eat into their consumption or whichever sector it is that's doing it. If they're businesses, it will eat into their margins. If they're households, it will eat into their discretionary income. And those things will take place into next year. So let's go back to my tweet. Let's see, where does it show it in here? No, I guess it's not in this tweet. There's a chart that I was trying to find that shows the maturity wall of debt from now over the next few years. And it really begins in 2024, where you have 2024 and 2025 where we start running into big walls of debts that need to be refinanced. And so that's where we run into this interesting dichotomy where we've got the market expecting these pretty mild and honestly very pragmatic 25 basis point cuts every 6 weeks out of the Federal Reserve from March to Christmas of next year. But you got a bunch of people with borrowers whose loans exist down here and rates are up there. So like just a few little piddly cuts are going to get us down to the ceiling of that period, that area of borrowers. And it's not a very articulate way of saying that. I hope I'm explaining this well. It lives in my head a lot more easily than it's able to be articulated on my stream. But that's something I think it's impossible to chart, right? I don't have private credit data. I don't have access to all these corporates like debt maturity walls and things like that. You'd have to go through all their filings and find that stuff. But you can see it appearing in news stories. And I've been talking about it a lot. I've been saying things like 100 bips of cuts are priced in, but it won't be enough to loosen the refinancing channel because it will represent an increase in borrowing costs for debtors. It's something I've been saying now for a while. And I saw this article from Bloomberg just a couple of days ago talking about exactly that. The amount of maturing corporate debt is set to double in the next 2 years to about $1 trillion in 2025 and triple in the Eurozone. Any business that has a loan pre-2022 is going to be facing higher refinancing rates. Companies rated below investment grade are particularly vulnerable. The maturity of the high-yield debt market is the shortest it's ever been in my career. That means that the amount of time that businesses have before their debts default when they need to refinance, that period of time is shorter than this guy, Jim Reed, has ever seen. And that's what I'm talking about. That's the maturity wall that sits out just ahead of us. And so if we're thinking about a Fed that's going to cut rates while unemployment is at secular lows, while inflation is about 3%, and financial conditions have already eased back to where they were at the beginning of Fed tightening because yields falling really dramatically, because spreads have stayed quite low. It strains the imagination to think that the Fed would cut enough for borrowers who are holding down here to see any kind of relief. They need hundreds of basis points of cuts from a 550 Fed funds down to like a 2.5 Fed funds or a 3% Fed funds. But why would the Fed do that when you have unemployment at secular lows? Why would they do that? Why would you do that when you have, is this the chart? Here. This is job growth. This is labor force growth. These two lines, and they're about even. So we've got positive job growth. We have positive labor force growth, and they're about on par with each other. So we don't have a bunch of people entering the workforce who aren't able to find jobs right now. It's about even. We have super low unemployment. Now, those of you who follow the channel, you know that there are parts of the labor market that are showing weakness, and we've explored this quite a bit. Those things are still valid. But if you're the Fed, you don't look at all of this stuff. The Fed's not looking at the 6-month annualized rate of change of job losers specifically as we are here. They have metrics that they follow. And if you're seeing CPI still at 3%, core CPI at like 3.5%, I've got a table that shows them all. Where is it? Here. Yeah. You've got 1 month, 3 month, 6% overall CPI. That's about, well, 6-month basis, it's still 3.1. On a 6-month basis, core is still 3%. Core services ex shelter on a 6-month basis is still 4%. On a 1-month basis, it's still 6%. So inflation is not defeated yet. The headline figure has come down, but various pieces inside of it are still at 2% or better, or or higher. Unemployment is at secular lows. And what does GDP now say? Open up. Open the GDP now. Show me. GDP now is about 1.25%. So if their policy where it is right now is working, why would they suddenly start cutting massively, right? If we still have positive job growth, inflation is moderating, real consumption remains pretty durable. What is their motivation to cut very much at all? To cut maybe a couple of times, that's fine, but a full-on easing of the kind that the market needs in order to refinance many of its debts, I'm not sanguine on that outcome. I think that there's more of this to play out. We've got at least another, where's my table? We've got at least another 6 months or so, 4 or 5 months of recession probabilities to play out. So once we get past March or April, then we'll have run out of recession examples. But then we still need to continue to monitor the rates of change of the data. Hopefully by that point, credit has begun to reaccelerate from its secular lows. Hopefully that by that point, we actually have some unemployment, just a little bit, because those things would actually cause the Fed to cut as much as is needed. We should hope for a bit of softness if we're expecting them to do that, because without that, I don't really see that outcome. I think that because of the fact that inflation existed in this cycle, their response function is more likely to be delayed because it was in the other periods where we had high inflation. Their response to the market, their response to the economy softening, and thus their easing of policy came later into the cycle than in other periods when we didn't have inflation. 1973-74 was one of those times. The 1981-82 recession was one of those times. They allowed unemployment to really tick up. They allowed the economy to weaken before they started to ease because of the existence of inflation. Now, even though inflation's come down, it's been a factor. And it was just 2.5, 3 years ago that they printed 40% of all the money in existence. So those things are still very prevalent in our current cycle. I've been kind of ranting here a bit. I'm going to take a break, take a sip of my water, and we'll check the chat. But that's kind of where my thoughts are right now where we sit with the cycle, because I think it was partly what makes today's FOMC so interesting, is to hear what Powell thinks about current financial conditions, whether or not he phrases them as sufficiently restrictive or if he tries to avoid that language, and what he hints at for future interest rate changes. I don't necessarily know that they're going to hike more unless inflation's really picked up again, but I'm not assured that cuts are on the near-term horizon with some of the other things I explained, with the way unemployment is, with the way rates of growth are, with what inflation has been doing. I just don't see that really coming. And that's what makes, like I said, what makes today's policy meeting so interesting. If you're here and you haven't hit the like button, please make sure to do that. There are 220 of you guys watching me, and however many likes we have, it's squished on my screen, but it has a 1 on the front of it, which means it's not 200 of y'all. So please go ahead and do that. I'm going to scroll back in the chat and see if I missed anybody. General Jackass says, how many microphones are you using? Is it only one microphone? Are you convicted on that microphone? Are you all in on the mic? Maybe you need to diversify. Maybe you need 10 mics. See a bunch of my homies in the chat, a bunch of friends who come in here a lot. Sick Thinker, Obaid, Matt Hebert, Ryan Rendon, Tomothy. See all you guys out there. Brandon Hammond, Alessandro, Troy Trades. What's up, y'all? Soft landing bros. That's a funny expression. Yeah, I mean, look, everyone's got their camp, right? And my goal is to not get married to a bias. So we've spent the majority of 2023 talking about recession, because that has been what the data strongly implies. And it still heavily favors that outcome. But we're getting closer to a period of time where it's possible that Powell actually threads the needle. It's not impossible. But we need to be cautious in making that kind of a declaration. I'm not just going to come out next week and just say that, right? There's still a lot more to play out. I'm going to give it till at least the point we passed here, right? Unless things just dramatically change between now and April. I want to see us get past this bar, and I want to see multitudes of economic data improving on their rates of change. Now, maybe what we need to do next stream is do a catch up for some of the audience who doesn't even know what some of these other tables are, because we've been looking at these for so long that some of you guys just already know what I mean when I show you this chart of cyclical rates of growth relative to recessions beginning. Some of you have seen this so many times that I don't have to explain it, and maybe I need to explain some of those things. But we've been watching the economy with a telescope, or with a magnifying glass, looking at all these different pieces, looking at the rates of change of credit, of the labor market, of cyclical parts of the economy, of demand components like income and consumption, in the manufacturing data itself, in soft survey data. We've been watching the housing market, everything. And talking about recession has been strongly supported by that data. It continues to be. Some things look really bad, like credit. Every one of these black lines is below the historical average, right? But then you look in other places, some of them are starting to tick higher, at least in rate of change terms. Maybe they haven't, maybe they haven't set new highs on their index level, but on a growth rate, 6-month annualized rate, they're accelerating from where they were 6 or 12 months ago. So if those things continue, then that will be constructive. We do want that. I don't want a recession. I don't want to see high unemployment. What I really want in my heart of hearts is for Jerome Powell to thread the needle and become the greatest Fed chair of all time. Like, just because that would be good for us, right? The people in the economy. That means people won't lose their jobs en masse. That means that we won't have 401ks tapped for emergencies. That means that assets can continue to grow. That means inflation won't be this bugaboo that just hangs around for years and years. I want that outcome. But I can't subscribe to it yet because there is too much left to play out. There's too many unknowns. And as much as I want that, I can't just pretend like that's what we're going to have. And when you look at things like delinquency rates on credit cards and their rates of change accelerating like this, then I have to think that we're just not done yet. Couple that with that rather inelegant explanation I gave for the maturity wall and how the Fed's amount of cuts probably isn't the same amount of cuts that current borrowers are hoping for in order to loosen up the credit channels. So we've got some time here, but it's worth being constructive. It's worth acknowledging that there are certain things that don't quite look that fucking bad compared to what they did months ago, right? Some things have started to look a little better. However, leading employment data, with this leading metric that we composed last week, a composite of several different components of labor, it is below typical growth rates and below our soft landing example. And the headline job growth numbers are perfectly in line with prior recessions and below our soft landing example. So I'm cautious. You know, whenever I talk about recessions with people that I don't have these conversations with often, I get a question pretty frequently of like, well, what's going to cause it? You know, like everything seems okay. What's the black swan? And I don't know. I don't think it's constructive to try to identify what the black swan is, because there doesn't have to be one, right? 2000 didn't have a black swan. It was just the most overbought tech bubble in history. So there doesn't have to be some major unexpected disaster, though that does tend to happen more often than not in downturns. That's when you get a lot of bankruptcies. That's when you get major businesses going under. That's when you get a lot of negative news because you're getting a negative shock to the economy and to the markets related to that economy. So it makes sense, but it's not a requirement. So if we just see rates of change slowly slowing down over time, then that in and of itself can be the catalyst, as long as something doesn't interrupt that trend. And an interruption of this trend would be a resumption of increased job growth. I don't know if we will get that. The only way we could really get that is if the economy stays strong and the labor force starts growing, right? We need more people coming into the labor force and then getting those jobs. Because right now, the vast majority of the people who want work have work. That's why unemployment is at cyclical lows, because we don't have an excess of labor supply. We have inadequate labor supply. So for us to see an increased rate of change of job growth in the future and not to just like hang out in this little stasis here, then I would assume, even though this is kind of our pre-COVID average, it's like 1.8, 1.7%. If we're going to hang out in here or even improve upon that, then I would expect to see some loosening in the labor force itself. We're starting to get that a little bit. You can see this blue line is ticking up just a little bit. But part of this is because of what we've been going through the last year and a half, right? People are running out of savings. Some people that were just on the sidelines are finally coming back in and going, okay, I didn't want to get a job, but now I'll get a job. You know, I was living off my savings and my unemployment and my side gigs for a while, but now I need work, you know, and so I can't find it. I'm going to file for unemployment until I do. We're seeing some of that ticking up, but we still have positive job growth. Most of the people who want a job are still finding work. So we're not at a place yet where it looks like the recession's beginning, though we're super close to it, you know, and if these trends continue, then we may look back with the benefit of hindsight and decide that December 2023 or January 2024 was the beginning of the recession, though it may not be apparent for a couple of months. That's normal, right? It's normal for job growth not to go negative until the recession has already begun. Here is when a recession begins. This vertical line. Here's job growth. 2 to 3 months later going negative. So are we near that point? Maybe. If we look at this chart, it sure looks like we're near that point. It looks like we're just a few months away from dipping down into the negative. So that's pretty interesting. Something else I looked at this morning. I debated showing you guys this, but I'm going to do it anyway. This is S&P price to earnings ratio. This is the valuations, right? Multiples. And this is broken up in different eras. So we've got all the recession eras in colors like we normally do. You can see those. I'll move it down to the bottom. You can see that here, right? Here's 1932. Here's today in black, 22, 23. And then I have them in different thematic eras up here. I've got pre-World War II. I've got the post-war golden age, which goes to like the early 60s. I've got inflation, which goes to the early 80s. I've got the Greenspan era, which is after Paul Volcker until the great financial crisis, right before it. And then I have the QE era, which is basically like 2006, 2007 to now. And then we've got today. And this is relative to Fed tightening. So the x-axis, these numbers, is how many months has the Fed been trying to tighten policy. And this line is the change in S&P multiples, the change in the price to earnings ratio from when the Fed started tightening to the end of tightening for that cycle. And there's a couple of observations. The first observation is that most of the time, as Fed tightening goes on, price to earnings falls, multiples fall. That's pretty true. Across the eras, most of them that is true. But there are two eras where price to earnings multiples climbed in the second year of Fed tightening, actually continued to get better. And it's these two eras right here. Now, one of them is today. The other one is 1929. That's not a good comp. I'm not saying that our outcome will be 1929, but I find it interesting that you've got people with a thesis about a big market crash. We've got people saying this is an amalgamation of the Great Financial Crisis and 1975 and the Great Depression kind of all mixed together. I've seen multiple analysts with those kinds of comparisons. We've looked at on here how if October of last year's low for the S&P marked the beginning of a new expansion, if that was the end of the bear market and we were going to continue going up for the foreseeable future, that it marked the highest starting point from a valuation perspective from any bull market expansion in history. We were beginning from a higher point than we had ever been at. And then, relative to when the Fed started raising rates in March of last year, multiples have improved at a better rate than any other Fed tightening cycle since the Great Depression. So I don't share this to put 1929 to the forefront because I don't want to make too much of an emphasis on it. I think that's too doomery. That was 100 years ago, and that outcome is not likely to be repeated in that exact way. But I think it kind of drives home the fact that this time has some interesting characteristics that are kind of a mix of many eras. Right? We've got labor tighter than it's been since World War II. We've got debts, public debt, higher than it's been since World War II. We had inflation higher than it's been since the 1970s and late 80s. But we also live in an era of QE and financial alchemy, the likes of which we haven't seen in prior eras, particularly out of the Fed. So I don't really know how all this adds up. And this isn't something that I work into my forecast of recession. This doesn't change any of my expectations. But this morning I was just looking at S&P PEs in all these eras, and this jumped out. And you see this spike here. I saw this as well. This is from 1990, but this was in the first year of the tightening cycle, and then it fell, right? Then they were in a recession, and everything was kind of going down. But that was in the first year of tightening. We have this era here, the late 50s, where multiples kind of went flat for a while, but they didn't continue to improve in the second year of tightening. The only times we've seen that are today and the late 1920s. And so that, I don't know, that just kind of tickles the spidey senses a little bit, you know? Let me look through the chat here. No background music, please. It's always distracting. Yeah, I don't think that I will play background music normally on my stream. I think I'll avoid some of that. Sick Thinker says, do you know the number one way you can support Alpha Beta Soup is to give that little like button a push? That's correct. Smash that like button. There's still not 200 likes, but I got 244 viewers. Hit the like button, please. It's all I ask. That, and maybe subscribe if you haven't already. Which variable could change the narrative to skip a recession scenario? Well, Mahi, we're pretty deep into this process, so I don't think that we could point at any one metric and say that's the thing that guarantees we're going to avoid a recession or not or whatever. But it will be a culmination of data points. So there are things that the NBER, which is the group who officially dates recessions, they've got 7 or 8 metrics that they use. A lot of those are fed into our modeling here on this channel. Things like both of the employment metrics, non-farm payrolls, household employment, real manufacturing sales, industrial production, real retail sales, incomes, and PCE. All those things kind of go into determining if the economy has had a downturn or contraction or not. So that's similarly to how I am looking at it. I would need to see a host of data points all pointing upwards, pointing the right direction. And I would want to see delinquency rates cooling off. I would want to see bankruptcy rates cooling off, the Fed lowering rates without inflation rising, and people being able to refinance without defaulting. None of that stuff has happened yet. So let's see some of those things happening, and then we can go, whew, we avoided the worst of it. But that's just economic analysis, right? That's not the stock market. If you're bullish on the stock market, be bullish on the stock market. I mean, it can continue to go up until an economic downturn is obvious. So by talking about these things, it's not a guarantee that the market has to go down until the recession is avoided and then it goes up or something like that. It isn't that binary. And to be honest, most downturns begin at market highs. So while the stock market, equities, asset prices are connected very much to the economy, they don't move at the same time. And asset prices, particularly equity prices, are often the last thing to recognize what's going on in the real economy. So that's also just important to point out and to keep in our minds that we talk about the economy, but it's kind of separate from the stock market. We can model them together and we can see their relationship. And we can see that when we have a recession, it takes out lows from the stock market from a long time ago, from 2 or 3 or 4 years or more in the past. That happens a lot. But talking about job growth and consumption and like where we are in the default cycle and stuff, those things don't hit the market unless the news is so bad it's unavoidable, you know? If you go back to 2007, let's go back to the Great Financial Crisis, and let's throw Fed funds on here. Let me get rid of some of these tables. One sec, guys. Clean this up. Okay. So we got Fed funds, and we got the stock market here. Here's the first cut. Right here. The market actually rallied on that news. You know, the Fed saw that subprime was melting down. Subprime started to melt down back here, but the market continued to set new highs. The Fed even started cutting rates, and there was an all-time high after the first interest rate cut, the next month afterwards. And then we rolled over, we bounced around. Bear Stearns collapsed somewhere in this period of time, but even that wasn't the doom call for the market. That wasn't the absolute Hades candle, right? That was over here. That was when Lehman collapsed, which was in mid-September, which was like right around here. I think it was like September 14th or 15th in this period of time right here. That was the doom candle. That we were already in recession. Let me show you. Here's recessions. Let me add it twice so it's on the bottom. Hold on a second. Move to existing pane below. Here's the recession. So they started cutting rates back here. The market dipped and then made a new high. The recession started. The market still kept bouncing around. Bear Stearns went under, still kept chopping around. The trend was down, but it wasn't completely collapsing. And then, 9 months into the recession, Lehman Brothers goes under, and that was the real shit show of the great financial crisis. This period of time right here. That was when we discovered all of the hidden leverage in the shadow banking industry, and that was when unemployment really went through the roof. From here through 2010, it continued to rise. And this was the really bad period of time for the market. That was when it finally broke below. When it finally broke below the prior levels, right? So I only point this out to really give you a sense of how these things don't all move in tandem in a binary way. There are flows, there are sentiments, there are different pieces of news that hit parts of the market differently. And it's not until you get away from the event and you turn around and you look behind you that you can really get a sense of how things played out and in what order and how they affected other parts of the market. You can't do that in real time. It's really difficult. And it was obvious that the subprime market was having serious problems by the time we were in March and April of 2007. We had certain subprime lenders already going under. By June or July of that year, Bear Stearns, a couple of their funds had like major liquidity problems, and I think they even shut one of them down. And then they went under, about 9 months later. But that was all happening in here. Bear Stearns had that happen, and then the market made a new high in October, like right after that. We had a recession start 2 months later. The market still kept chopping around. People didn't know we were in a recession right here. Ben Bernanke went in front of Congress somewhere in this box right here. Let me make it a little more red. Somewhere in here, Ben Bernanke went in front of Congress and said, we don't have a recession. We were literally in one. And he told the public there's no recession. You can go look it up. Let's go look it up real quick. Ben Bernanke, 2008, no recession. Bernanke sees no recession, but big challenge. February 27th, 2008. Right here. Right here. No recession. We're not in one. It's fine. We had actually been in one for 2 months with the benefit of hindsight. We had much more ahead of us to go. This kind of has similar feelings to Janet Yellen coming out right now and saying people have nothing to worry about with the economy. Everything's fine. You shouldn't worry about U.S. debts. Everything is great. People are feeling good about Bidenomics, whatever mouthpiece crap she says for the administration. Now, I'm not guaranteeing we're in a recession or that we're about to have a great financial crisis moment, but it just shows you that nothing is clear as it's happening. The chairman of the Fed went in front of the public 2 months into a recession and said, no recession. So take that for what it's worth. At 3.7% unemployment and decreasing demographics, how long can job growth realistically remain positive? It's a good question, Alessandro. Part of the thing is, there's always some amount of job growth, right? There's always some turnover. There's always some people coming back into the workforce who left some period ago. There's new people moving to America and needing jobs, right? Some kids finally entering the workforce for the first time because they just got out of school or whatever. And so the number can be positive, but in rate of change terms, it's definitely slower than it used to be. It's much slower than it used to be. Let's go look at it real quick. You can see that here. Let me take off this thing on the bottom. You can see that here. You can see the rate of job growth in the, oops, that's yellow. You can see the rate of job growth post-COVID was about 1.7%. That's the average of this window right here. But if you go back to the 90s, it was above 2%. If you go back to the 60s and 70s, we frequently were spiking above 4 and 5% job growth because we had massive demographic strength, right? We had the boomers becoming adults, entering their prime working years. Boomers born back here became 20 years old in 1965. And that was what we saw. That was this big swell minus a couple of the recessions. That's also what helped to keep unemployment high during this period of time, which we've talked about before, was that the labor force was growing much faster than job growth. We had a bunch of people entering the workforce at a faster rate than the economy could give them jobs, because you had the boomers, like I just said, and you had the women empowerment movement where women were leaving the house and joining the professional workforce, right? Starting careers. All that was kind of happening during this period of time and into the 80s through here. But labor force growth is much smaller now. And even though we've just looked at a chart a little bit ago that shows that they are similar, jobs and labor force growth are similar, and the labor force has been picking up a little bit, it's nowhere near where it was back here in the past. So you're right, it is slowing down, and it possibly could remain quite low. What actually bothers me quite a bit is, let me slap this on here. I'm going to show you something real quick. USA population change by year, fit width. It always does this. Let me fix my calc real fast. Sorry guys, 1 second. Yeah. So what is this? This is US population growth, not in percentage terms, but in people terms, right? Percentage growth can kind of hide some of the weakness because you have very large numbers. And so it's harder to grow a larger number at the same percentage. So the percentage growth of population goes down over time, even if you have a healthy population. But this is the count of new bodies entering the US population every year, right? And you would think that as your nominal population continues to rise, which is down here at the bottom, this is the actual population in millions. As this value continues to grow, if people were having kids at a relatively consistent clip, you would expect the number of people being added to the population every year to stay relatively high, right? To continue to slowly climb higher over time, as it did here. From the early 1900s until around the 2010s, 2015, around that area, the number of people being added to the population every year was on a steady uptrend. But that has rolled over completely. And it didn't just roll over from COVID, it rolled over here. That's 2015, right there. That's about 5 years after boomers first entered retirement age. See that right there? And so what worries me about the US moving forward, and you can apply this same analysis to the UK, to other parts of the Eurozone like Germany and France and Italy. You can also do this to Japan and China. They all kind of look like this in different ways. There are different Some of them are further along than others. But all the boomers hit retirement age right here. And we have people having less and less children, right? So the population growth has completely fallen off a cliff. The biggest generation in history is now well into retirement age. They're not having kids anymore. And the fertility rate of each of the subsequent generations has been lower and lower. And we finally hit a breaking point somewhere around the 2010s where the nominal growth of population every year just fell off a cliff all the way down to where it was 100 years ago. This is during World War, when is this? This is during the Great Depression, sorry, not World War II. During the Great Depression and during World War I are the only other times when we've had weaker nominal population growth in the US than we've had in the last 4 years. So I think that will have an effect on the ability of labor to continue to grow. And it makes me wonder where real organic growth is going to come from. Because if you chart population growth next to real GDP, they look really similar to each other. I don't have it in this table. But real GDP and population growth look really similar to each other. So if we're going to have population slowing down, then it makes me wonder where all of the organic growth is going to come from for the US economy over the long term, right? This is like a decades long trend. This doesn't mean, the next 2-3 years, but it's just something from now to 2033 and into 2043, the US really has to start thinking about. Let me show you what I'm talking about here. Immigration. Here. According to the Congressional Budget Office, U.S. deaths will outnumber births starting around the year 2043, making net immigration the lone driver of population growth. What have we been talking about? Population growth falling off a cliff. Blue is net immigration. Red is births minus deaths, meaning organic population growth by citizens of the U.S. And based on the rate of change, how it's been falling off a cliff, it's expected to be straight up negative 20 years from now, which means that the only way the U.S. population will continue to grow after that point is if we increase immigration or we convince people to start fucking a lot, like now. You need to start having kids now and next year and the year after. And every year in the future, we need people to have more children. We need to make it more affordable and more appealing for them to have kids, because right now they don't feel that it is for multitudes of reasons. And we will run into a wall sometime a couple of decades from now where real population growth will just not be there anymore. And we'll need some kind of a release valve. So either people start having more babies, or we let a lot more folks in, or growth suffers. Those are, in my opinion, those are the three possible paths. But that's further on in the future, right? I love talking about this stuff. It doesn't mean it's all relevant today. This is just us playing around with data, right? Looking at our world through data. Catching up on the chat here. Oh, wow, I missed a few things. Let me scroll back. Ryan Burns says, most bankers I speak with, I'm a corporate treasurer, do not anticipate 5 rate changes and don't expect a rate cut until June or July. That's really interesting because, the market, like we said at the beginning of the stream, they're expecting cuts perhaps as soon as March. But definitely by May, the market thinks it will have cut at least 25 bips, and maybe we do. But the question then becomes, are those cuts enough? Are they enough to dislodge mortgage, to dislodge refinancing? If the Fed only cuts 100 basis points and mortgage rates are still up here, and you've got all these people who bought homes down here waiting for them to cut so they can refinance, all these people are going to be left out in the cold. This is true for the corporate sector as well. It's just not using a mortgage chart as the anchor. Looking through the chat. I appreciate you guys hanging out. Still need a few of you all to hit the like button. We've only got, how many likes is that? I can't see. 185 likes for 225 viewers. 50 of y'all need to hit that button. Added sanguine to my word bank. That's good. It's a good word. David Kyra gifted 5 Alpha Beta Suit memberships. Dude, thank you so much. I totally forgot to mention that. I turned on chat memberships. So this is what I was thinking about. I'm so glad I looked back and saw this. I completely forgot to mention this to you guys. So I turned it on. It's totally optional. It's just a way for you to show support for the channel. It's the same thing as like a Twitch sub. It makes your name a different color. In the chat, we got a couple of icons. I am going to work with someone to get a few more emojis and things for us to have in the chat. And what I think we'll start doing is, for anybody who's subscribed, we can start doing a member stream, maybe like once a month or something, where we'll just do another chat, kind of like this, but less intended for the broad audience, where we just kind of hang out. Maybe I can show you how I make some of my charts, how I put data together. We could talk off the cuff other things. We can answer questions more directly. And so I think we're going to start doing that. For anyone who is a member of the channel, you'll see those, and we'll do the first one probably after Christmas, because the next week is really busy. So we'll probably start doing it maybe right after Christmas or something. I'll make sure to let you guys know. But I did enable that, and David Kyra got the first membership and got gifted out 5 of them. So welcome everyone. Welcome Paul, Daryl, Sean, B Skeet, CB. Sick Thinker also became a supporter. Thank you very much. Love you guys. Ryan Rendon, a new member of the channel. Sib, welcome. Alessandro, also a member of the channel. Thank you so much. Appreciate that. Thanks for giving out the gifts, David. Very generous of you. You don't have to do that. It won't keep you from seeing these streams. I'll still come and do this every week. But it's just an extra way for you to support the channel, and also for us to have just a little extra content that's just for us. So we'll definitely do that. And in those monthly streams, I'll be, a little more open, showing you guys behind the curtain about how I do some of this stuff, because I do stay kind of private in public. So that's kind of where we're at. Let's go look around the market just a bit before we start wrapping this up. I'm going to keep you guys to an hour and 15, hour and 20 minutes. I don't want to have another 90-minute stream. Just to kind of touch on the markets just a little bit before we get out of here. I've been watching Bitcoin a lot because it's in a really interesting place. It's finally showed a little bit of weakness after this relentless grind. Because if you think about this move here, from really the last week of October until just a few days ago, every single person who bought the dip on Bitcoin, basically, shit, you can go back even further. You can go back to here, excuse me. Every person who bought the dip basically since September has not been required to feel really any discomfort at all for more than like one day. And we're finally starting to see some weakness on BTC. If we look at momentum oscillators, like we look at MACD, RSI, and the stock, we look at it on like a daily. Let's look at it on daily. Oops. Oh, I already had some of those on here. Well, look at me, I'm being silly. Okay. You can see some of the momentum has started to roll over. We set a lower high on RSI. We got a bear divergence here as price continued to set new highs. And, I'm really kind of wondering how far back we pull here. I think that we've got some support around this area. This is where we saw some really nice curling action before the breakout. And when you see this kind of price action where you've got a really solid underlying trend here, but you keep having these up thrusts that are of different lengths and different heights, but they all keep coming back and touching the same pretty solid underlying trend, then a lot of times once you finally get a breakout, it eventually comes back down. It's almost like it's preparing for the dump. We see this action it's more on high time frames than low time frames. But I think after seeing this clean breakout, knowing that really none of these holders have ever been made uncomfortable, I think that the market is seeking an equilibrium down here somewhere, and that we might come down and test this 38 level sometime in the next week or two. I think it's likely, but first we need to get below 40,000, which was last week's low. So we'll see if that plays out. I had a long that I was in from 35, and I ended up cutting it up here because I had a trailing stop. So I'm actually completely out of all my trades right now. I still have some spot bags that I'm holding, but all my leverage trades have closed out. So my ETH and my Bitcoin long that I've been writing from down here, both of those I'm out of. So I made about 200% on both of those. But I'm just kind of watching Bitcoin here to see the structure. Nothing has really been invalidated on a high time frame. Like, this is the weekly chart, and it still looks pretty good. There's no reason to really be concerned. But some altcoins are acting like Bitcoin has topped for a little while, right? Like TRB, Algo, a couple of others took off in the last couple of days, almost as if they know that Bitcoin has cooled off for a bit. That's usually what happens. Bitcoin moves up, it cools off, altcoins move during the rotation. We're seeing a little bit of that, but high time frame structure is still fully intact, and we're well above the kind of liquidity zone that I thought we would actually go down and test. If we get down here, I would look for some action to get long again, to come back up into these highs, just for a trade. I'm not talking about the multi-month direction of Bitcoin, but just on a daily basis. If we see maybe a swing failure of this level, or price gets below it and then comes back up and starts setting higher lows, then I would look to get back in and take it back up here. Clearance thrust. That's right. That's the term I was looking for. Flippa XBT. Thank you for saying that. There's a guy named Paracurve. One of my buddies, I think it was XO, actually. I think it was Trader XO. It was for sure. Trader XO sent me a link to this guy Paracurve's website, and he kind of describes a lot of different chart patterns. And one of the things he describes is something he calls a clearance thrust. And that's what this is. That's exactly what this is. Clearance thrust. You got a nice, solid ascending base. You got all these attempts to push price higher, but never really getting out. Once you finally break out, it's a strong move up. It's a strong move up, and then eventually you come back down and test that level of support. Now, maybe it holds, maybe it doesn't. That's a move for another day, but that's what I was looking at. Yes, exactly. Clearance thrust. Thank you. Headstrong, welcome to the channel. Mr. Six, welcome to the channel. Thank you guys for joining. I really appreciate the support. Very generous of all of you. Spruce Moose asks, what do you think's the likelihood of a soft landing, given the decrease of CPI, PPI, and still relatively tight labor market? Thanks for the great content. It's difficult to put a number on. If you'd asked me 6 months ago, I would have said the likelihood of a recession was 85-90%, just based on data at that point in time. Based on where we are today, I would say, and again, this is not a rigid calculation. This is me mentally going through the probabilities in my head and coming up with a number that feels right. It's a gut check number, so I don't want you to hold me to this specific number. But I would say if a few months ago, or early summer, the likelihood was 90% plus, I would say the likelihood now is more like 70%, 65-70%. But it's falling, and it will continue to fall over the next 6 months if data remains constructive. So, all right. We do have FOMC today. The press conference is in a little over an hour and a half, I think. I'll be paying attention to what Powell says. I'll be paying attention to how much he talks about financial conditions and whether or not they are restrictive. Because as I mentioned offhandedly earlier during one of my monologues, I guess this whole thing's a monologue, financial conditions are back to where they were at the start of the tightening cycle. Let me show you real fast before we get out of here. You see this right here? This black line represents the National Financial Conditions Index by the Chicago Fed. This is like an official figure from the Chicago Fed. And they show right here financial conditions are where they were at the beginning of 2022. If I take all this off, we are right here. That's where we were in February of 2022, which was a month before the first rate hike. So financial conditions have eased already. Labor is still tight. Inflation is moderating, but remains above target. And the market's expecting a ton of interest rate cuts. So we need to pay attention to what Powell says about financial conditions. Maybe try to interpret his own reading of inflation and whether he thinks it's going the right direction, how much more time he needs to see that number favor his outcome before he says, okay, we can declare victory. Those things are dynamics to pay attention to if you are a Fed watcher. I think that he will not give any major alpha away. Powell's not usually the type to do that. And there's been a couple of times in this cycle where he has gotten out ahead of the narrative a little bit and he's had to walk it back. So last summer that happened when he started talking about disinflation in June and July. And then he had to come out in August and lay the smack down at Jackson Hole and tell the market that they were wrong. And then early this year in February, he started talking about disinflation a whole lot. The market got really excited. He had to come back out and talk him back down. So I think that he will be reserved in his comments, but we might still be able to pick a couple of things out and we'll just see what he says, right? I don't think that anything will change today, but for people who pay attention to language and who understand that their forward guidance is one of their tools, their language is important. So that's why we pay attention. So, with all that said, okay. Is Twitter not going to open? Does Twitter not forward to YouTube? Oh no. That's unfortunate. Twitter doesn't open the YouTube link. Well, that might explain why I only got 30 subs. Okay. Well, if you are not currently subscribed to my channel, you need to be subscribed. Subscribe here. Consider joining as a member. You will get a fancy green color in chat. You'll get access to a couple of emojis, and we have more coming. We will also do member streams. We'll do the first one probably in a week or two, and I'll make sure I announce it at least a day ahead of time for you guys. I appreciate your support. The best way to support the channel is to subscribe and to hit that like button. We will do another one of these live streams about a week from now, next Wednesday or Thursday. That's not Christmas, is it? Okay. Next Wednesday or Thursday, 20th, 21st. That's when we'll do our next stream. So keep your eye out for the notification for that. If you have any ideas about what else we should do with the memberships, or you have ideas for emojis and things like that, send me a message. I'm open to that kind of feedback. And I think what we'll do, I've been trying to play this through in my head. There are a lot of folks who watch this channel who haven't seen the Recession Roundup series. And we look at a lot of those charts together as a way of updating where we are now. So I think what I might do next stream is do kind of a crash course, at least for the first part, of catching folks up to the crash course of this, not the whole thing in detail, but just kind of like, these are the metrics, this is why we care, here's where they were, here's where they are now, and that way everyone can kind of be on the same page. I think that might be helpful, so we might do that next week, unless something happens between now and next week that warrants talking about. So that's it. Until we chat again, take care of yourselves, friends. Take care of each other. Go outside this weekend. Find something interesting to do that's away from the charts. Catch the FOMC press conference in an hour if you're into that kind of thing. I'll be watching. And keep in mind, I'm not a financial expert. I am not qualified to give financial advice. Nothing on this channel is meant to change the way that you invest directly. I'm just a guy at my house doing my own personal research and creating videos about it. I have never worked in finance. I used to be a bartender. So don't make money decisions based solely on what I say. I hope that you use my research to inform you. I hope that you enjoy my content and find it entertaining. But they are just my opinions, after all. My opinions backed by a copious amount of historical data and my own understanding of markets and economics. I never went to college. I don't have an economics degree. I don't even know what they teach in those classes. So take everything I say with a grain of salt. Do your own research. And that's where we'll leave it today. I love you guys. Thank you for the support. Thanks especially to those of you who became members today. Thanks to David for buying some memberships for everyone. Thanks to those handful of you who were here before the stream even started. And we will meet again in just a few days, my friends. Cheers, everyone.